And I think that's good because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, it's kind of just treating that as a separate, less important pool of capital and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years.
Alden Lyn highlights her macro-driven framework for comprehending the fluctuations in the price of Bitcoin in the beginning. She concentrates on monetary signals, fiscal policy patterns, and liquidity cycles that affect long-term value rather than tying herself to short-term goals. She notes that although the trajectory of Bitcoin can be unpredictable, its performance frequently corresponds with shifts in real interest rates and the state of global liquidity. Alden also emphasizes how monetary devaluation and structural debt problems support the long-term bullish outlook for Bitcoin. She considers the wider picture when assessing risk-adjusted returns and asymmetric possibilities rather than trading hype cycles. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
I try to give conservative targets. And for example, I was pretty sure we would hit 100K, and we did. I thought maybe we'd hit it in 2025. It was interesting that we touched it late last year. What I tend to monitor instead is levels of euphoria. So instead of saying, it's going to go to this price by this year, there's a couple of things I look at. One is Bitcoin tends to correlate with liquidity conditions. It generally does better in conditions where liquidity is going up, which is in some ways another way of saying debasement's going up, which is different than just CPI. And then the other one is like when you look at some on-chain characteristics, one of the big ones I look at is market value compared to on-chain average cost basis. Because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about, want to be able to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like, to put it in real estate terms, if there's like say 20 houses on a street, and none of them have sold, bought or sold in years, and one of them finally changes hands, and it's 50% higher than its last price, generally speaking, the value of that the whole street now is higher, even though only 5% of the houses, 1 out of 20, have basically now moved the price, the perceived price of all those houses. The same thing happens in a more liquid sense in Bitcoin, which is there's a bull market around the margins. It's tightly held. Some influx of capital comes in. Bitcoin goes up really quickly. But when you look at how many coins actually changed hands, it's usually a pretty small percentage in that initial bull run. And then you kind of like want to see that become more real. So for example, on that house street, you'd want to see another house sell at like a similar price, and maybe a third house before you say, okay, this is probably like something approaching the new price of the street. We can have more confidence in it. And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio, because basically the cost basis, the average cost basis, is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices.
Mm-hmm.
So far it's in line with my base case, which was that they probably would ring fence their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that. And that's what the executive order said to do. Basically take those coins and put it into a separate reserve and don't sell them. I think the slight upside of the executive order to do it was that the Treasury's authorized to explore budget neutral ways to accumulate Bitcoin a little bit more. I expect that to be kind of low numbers, but maybe I'll be surprised to the upside. And then they also, I think, did a good job of separating out Bitcoin from the rest of the cryptocurrency space, because they put those, again, from like forfeitures and reserves, forfeitures and seizures, they put them into a different bucket, and is treated differently, because the Bitcoin one, by executive order, they're not allowed to sell it. Whereas by the same executive order, the Treasury Secretary can use their judgment to figure out what they want to do with other coins, which can include selling them. And I think that's good, because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, it's kind of just treating that as a separate, less important pool of capital, and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years.
According to Lyn Alden, gold's recent impressive performance is consistent with its historical function as a hedge against the depreciation of fiat money. Gold's 5-year trend appears sustainable despite a 40% annual increase, particularly in light of ongoing global economic changes. Gold's long-term strength is further enhanced by the strong demand from nations like China and India. She also discusses stablecoins expanding significance in international finance. Stablecoins facilitate international investment in U.S. treasuries by giving investors access to digital U.S. dollars outside of conventional banking systems. This arrangement contributes to the continued dominance of American assets in international capital markets. But according to Alden, the world may gradually shift away from a strong reliance on U.S. treasuries and toward more neutral assets like gold and Bitcoin, which might change the way that global banking is structured. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
Well, I think stablecoins already are proliferating pretty significantly. I do expect that to be up and to the right over the next 5 years or so, which through this administration and into whatever happens next. And I think the issue there is, if you look at those two charts you showed, the first one is the U.S. Is the rest of the world reinvesting in treasuries and capital assets, whereas the second one is basically having them invest in manufacturing facilities and put surplus into gold or Bitcoin and other kind of neutral assets. Whereas actually what the stable coins do is they keep the first chart in place. They keep a portion of the world reinvesting in treasuries to the extent that they're successful, and that's where there's a little bit of a conflict potentially.
Got it. So how do you think this plays out then? What are you thinking?
My expectation is that this is probably going to be a very long process, much how the deindustrialization. I think the deindustrialization took decades to occur and reach a scale that became like politically among the biggest things, that to the point where an administration would start highly prioritizing it. And I think this is an initial set of first steps to say, okay, we're at least talking about the problem, doing steps to address the problem, and I think that there probably will be fits and starts along the way, and it'll take decades to gradually unwind that and kind of reindustrialize. Well, so I think it's basically a potentially initial unwind, a very tiny percentage unwind of a very one-sided trade, which is due to dynamics we discussed kind of at the beginning of this talk. A lot of global capital is stuffed into U.S. stocks. Kind of like how a lot of global capital is stuffed into Canadian real estate and Australian real estate. For us,
I love how you keep bringing that up, because it's so true. Like, you're 100% accurate. Yes.
There's certain parts of the world that we monetize. And for the U.S., kind of the biggest, most liquid market is our stocks. And so the whole world monetizes our liquid assets pretty strongly. And basically, that can become self-perpetuating because that also strengthens the dollar. And then a stronger dollar hurts various emerging markets that have dollar-denominated debt. It kind of squeezes them, which makes them even less attractive to invest in. So even more global capital is like, you know what, I don't want to touch any of those areas. I just want to be overweight US. And so that's a flywheel that's like self-perpetuating until either it reaches such extremes that it exhausts itself. Like every marginal, like portfolio manager is basically, net long or overdone US stocks, and there's really not much more marginal flows that can happen. Or there's a policy shift that starts discouraging that flywheel or disrupting that flywheel, either intentionally or unintentionally. And I think we're basically seeing a combo of both. I think that the move is kind of exhausted, and then we are seeing some policy shifts that add uncertainty and make maybe some of that capital want to repatriate or go home. And I think it's disruptive when it happens, but I think it's healthy ultimately because I think that it's gotten rather imbalanced. So I think, it reflects a lot of the debasement that happened over the past 5+ years. It can take a while to trickle out. When everything was booming, people were more interested to put it in stocks than in gold. But as things eventually kind of slowed down, some of that capital, I think, spilled over more into gold. In addition, there's been a really strong central bank bid for gold over the past several years, even though the rest of the world, on average, does hold more treasuries nominally than they did 5 or 10 years ago. It's a really slow growing figure. And especially when you look at official holdings, like central bank holdings, it's basically flat to down on treasury holdings over like a pretty sizable timeline, like 10 years. That was really kickstarted by China when they said something, like 11, 12 years ago. They were like, it's no longer interested to rapidly accumulate treasuries. We're going to instead recycle this into Belt and Road Initiative stuff. So that was kind of a catalyst for this. But we have seen central banks continue to accumulate gold.
Lyn Alden concludes by providing us with a broad overview of the state of the global financial system. She clarifies that the recent 40% annual increase in the price of gold is not merely a passing trend. Rather, it reflects more fundamental problems, such as years of central bank money printing and the long-term depreciation of fiat currencies. Gold continues to play a strong role in protecting wealth as people begin to search for safer, more dependable assets. She also notes that over the past 10 years, central banks, particularly those in nations like China, have been steadily purchasing gold rather than U.S. treasuries. This change, which began years ago, demonstrates how even big institutions are gradually shifting toward alternatives as they lose some faith in conventional dollar-based assets. Alden discusses how the existing financial system is being maintained via stablecoins, which are digital currencies linked to the U.S. dollar. Stablecoins are enabling international investors to continue purchasing U.S. treasuries without going via the conventional banking system by providing easy access to digital dollars for individuals and nations outside of the United States. This helps the United States maintain its financial hegemony for a little while longer. However, Lyn notes that this could not be permanent. Over time, more nations and investors might decide to shift their focus from relying so heavily on U.S. assets to more neutral repositories of value, such as Bitcoin and gold. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.